Today, we're looking into stocks that are under the radar, stocks that we simply don't talk enough about. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique. Today we are doing some kind of like my favorite type of show where we're going to talk about a bunch of stocks. You're going to ask me questions. You're going to have a lot of fun.
Yes, today we're diving into 6 dividend stocks you've probably never heard of, listeners, but surely they deserve a closer look. For each stock, I will ask you, Mike, to share your thesis and potential risk. But I also tried to add like interesting angles to them so you listeners can learn more about those businesses.
Yeah, I just love discovering new companies. And among the list that we have today, we have a few shout outs to make to DSR members, because it's kind of funny now that across all our members, the way that we teach how to search for companies and to do the filters and using our database, they are the ones coming up with ideas. And they're just like, hey, Mike, have you ever heard about this one? And I'm like, no. But then I look at the dividend triangle and I'm like, oh my God, like the revenue keeps on growing, the earnings keeps on growing, the dividend is there. And then it gives me like more ideas to dig in and to potentially find some great companies to add to my own portfolio.
Right. So before we start, remember that the stock ideas we will share today should not be considered as buy or sell recommendations. You must always do your due diligence, see if these ideas align with your investment goals. Mike, let's start with one that we've mentioned before, but that's still pretty much unknown to most people. Jameson Wellness, JWEL.TO, and I got it right. Yay. What do you like about the business model beyond people take vitamins?
Actually, it should be enough. Jokes aside, Jameson Wellness is actually the leader in vitamins and in nutriments in Canada. It's kind of ironic because it's a small cap, but it's the leader in Canada. So kind of like the big player here, but not such a great big player all over the place. And it's probably why the company flies under the radar among a lot of investors. It's not big, it has a small yield, and it is very niche products. So we're talking about vitamins, as you mentioned. We are talking also about herbal and mineral nutritional supplements. That was really hard to say. Sorry, guys. So everything for your health, everything to, as people are aging, they need those supplements as well. So all those small bottles that you pay a hefty price for them. And what I like about it is also that comes with repetitive purchases. Once you start buying, and I know that like my wife has like plenty of those like nutriments, and once you start taking those and they are good for your health and you see a change, you're not going to stop. You're going to keep on buying them, and that's going to work, right? So there's a lot of organic growth as people are aging. And the other thing that they do is that they spend a lot in advertising. So they have used also influencers on TikTok, on Instagram. They're growing very fast in China. So again, and this is one thing that I've discussed in previous shows a while ago, the fact that the revenue keeps on growing double digit all time, but their expenses creep up as well. So at one point you spend so much to gain customers that the earnings are not always growing at the same pace. It's a good thing when you're in the growth phase though. So they gain market shares in China. They made the acquisition of Youth Theory in the US as well. So I like the combination of organic growth and growth by acquisition as well.
But Mike, you've said it, Jameson competes against much bigger players. Can it face that competition, and what are its other risks?
So definitely an important point here. I mean, when you face companies like Kenvue, which was the consumer healthcare spinoff from Johnson & Johnson, it's going to be acquired by Kimberly-Clark, actually. But when you think about those big names, and then you're thinking about a company that has like a market cap of like $2 billion, not exactly the same weight, not the same marketing budget either. So it's important to be very niche. I think their marketing strategy is good enough to put their brand in front, but definitely they're doing a lot better in Canada for that than outside.
Hmm.
They also face local competitions. So, I mean, every company is trying to gain market share in China, regardless of their products. But at one point, I mean, Chinese are not that dumb. They're thinking about, hey, I can make money out of that. So let's start our own business and compete against those North American companies. And we see how they did it well with Luckin Coffee versus Starbucks, for example. So
Hmm.
again, they're going to face that kind of pressure. I already said it before, but their main growth vector is investing a lot into marketing, which is great, but also it could eventually go the other way around where you end up paying too much to acquire new customers. So it's really important to deal with this arbitrage where each dollar spent must get more customers back and not overpay to get them.
Right. Okay, so now let's bring in an underdog tech stock to this episode, Roper Technologies, ROP. Roper has had a double-digit dividend growth rate for the past 17 years. So why is it still under the radar for most investors, Mike?
Not that bad, right? Not that bad.
Right.
Well, the thing is that Roper Technologies is not making AI chips, I guess. So it's not part of the AI hype. I would qualify it as the US version of Constellation Software, more or less, in a sense where they are making a lot of those software, but they're also growing through acquisitions. And their goal is to serve vertical markets. So when we're talking about like very specific niche markets, I already given that example when we're talking about Constellation Software, but imagine that you have like a dentist clinic. Well, you need software to run your clinic, but they're quite specific to your
Hmm.
practice. And they will probably, I mean, yes, you could buy a general software to manage your clients, but it's not going to be exactly what you need. So those are the types of businesses that are able to create those software and get a little bit closer to business owners to create that sticky relationship and offer those like subscription and maintenance services. So you have a lot of recurring revenues. And what Rubber Technologies has been done over the past few years is also to make a lot of acquisitions. So there are tuck-in acquisitions. So either in the same vertical niche that they're servicing or other products that they can do cross-selling opportunities as well. So the company is being doing well, growing, as you mentioned, the dividend, but the revenue as well, the earnings is also, but not doing that great in 2025 on the stock market. So maybe there's an opportunity to dig a little bit further and maybe find a stock at a price weakness, which is not
Hmm.
that easy these days.
Right. But their model is very acquisition heavy, as you've mentioned. It's a strength, but it could also be a weakness, right? So what are the risks for investors?
Yeah, so similar to Constellation Software, at one point, the problem is are you going to be able to find enough companies or software to acquire to move the
Hmm.
needle? As you become more important, every small acquisition will not necessarily boost that much. I mean, it's like saying, oh, I got a pay raise. It's like 1 cent an hour. I mean, yeah, I mean, it's technically a pay raise, but you're not going to buy a new car with that. You need a little bit more than
Right.
this, right? So that is one thing. The other thing is, of course, to convince investors that they are a great business and people should invest in that business, they rely a lot on those acquisitions. So going further, they also need to make sure that they integrate them, that they're still tuck-in acquisitions, making sure that they fit within their playbook. So most of the time when you see those serial acquirers, they have like buying rules similar to an investor. But if you're buying too many of them, sometimes you're trying to be a little bit more relaxed on your rules and just for the sake
Hmm.
of keeping a large pipelines of potential. And this is where you could make bad ones and overpay for an acquisition or simply not being able to integrate it the way you thought, creating the synergies and so on. So this is definitely the biggest risk for Robert.
Okay, so let's now move on to exchange income, EIF.TO, which pays a monthly dividend and does business in a niche market. I mean, an underdog that pays monthly dividend, that's pretty rare, right?
Yeah.
So what else is there to like about it?
Yeah, it's another small cap flying under the radar, probably because of its size. And it's kind of weird because exchange income, you may be thinking, oh, it's probably a bank or like a
Right.
financial firm or something like this, but it's actually an
Mhm.
industrial stock in the aviation services and manufacturing. And even more confusing, their manufacturing part is not necessarily about making aerospace parts. They can do, yeah, I know, it's kind of crazy. It's like two companies into one. So you have the aviation business. Most of it is like servicing northern Canada, which is really great because it's sticky. They don't have much competition over there. And on the manufacturing side, they have like environmental access solution. They have multi-story window solution that has absolutely nothing to do with aviation, precision and manufacturing engineering. And they're growing by acquisitions. So they focused on those small manufacturing companies and they included them into their model. So it's almost like a mini fund of investing into industrial stocks. And
Right.
it's kind of ironic because it's all over the place, but at the same time, it's good because it had some balance with the aviation becoming a more stable and sticky business, and the manufacturing is more cyclical. So when the economy is booming, they're going to do a lot better, and when it slows down, this is the part of the business that will drag the results. But having on both sides, it helps to continuously improve the business and provide that monthly dividend payout. One other thing that I was quite surprised of, because I followed that stock throughout COVID, and during the lockdowns and stuff, the dividend was quite at risk in terms of like you look at the payout metrics, the earnings that were in free falling, and yet they were able to maintain the dividend during that period and started to increase it afterward. So sound management, very solid business, and it's skyrocketing in 2025 as well. So getting very good returns. I added it to my Smith Manover about a year ago, I think. I can remember when I added it, but I just wanted to take kind of like a guess on this one. I mean, it's a small investment,
Mhm.
but I'm super happy about the results so far.
All right, so at Dividend Stocks Truck, we have DSR stock card, which are pretty much stock analysis. And on the DSR stock card of Exchange Income, we can read EIF faces liquidity challenges, economic sensitivity, and integration risk from acquisition. So what does that mean concretely, Mike?
That's a long list of risks, right?
Right.
I mean, the first one is it's great to grow by acquisition, but one thing that you always have to keep in mind, besides the integration risk, is also how much debt you have to get to make those acquisitions. And the debt is fueling the growth, but it's going up very quickly. So at one point, it's a double edged sword. You will have to
Mm,
pay it off. You cannot just keep on borrowing and borrowing and borrowing just for the sake of generating more revenue growth. At one point, you'll have to say, hey, you know what? We'll have to keep a good part of that cash flow and pay down that debt. So that's definitely a risk. Manufacturing business is cyclical. So as I mentioned earlier, it's a great thing that they have the aviation business at the same time, but still, if half of your revenues is struggling, it's not going to make good quarterly reports. So you have to be careful with that, especially with all the data and the concerns that we have with the tariffs and the commercial wars, and maybe we're going to get into a recession at one point. So I mean, this is a type of business that is highly sensitive for that, and it's even worse because it's small capitalization. So keep always in mind that smaller companies tend to provide higher returns over the long run, and especially in bull markets, but they're also taking the biggest hits when the market goes down. When you invest in a company like this, you have to know it's very possible you would be down 30% at one point, and it's like that would be just another Tuesday. So you have to be aware of that.
right.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
Okay, so the next stock of today could definitely be considered boring. So A.O. Smith, AOS, specializes in water heaters. Why does this make your list of hidden gems, Mike?
Seriously, how, like, I explained to someone how I convinced my children to invest and how I set them up not too long ago. And that person, I told her, I mean, okay, so we started with ETFs, but to make it interesting, I suggested my children to buy a few stocks of companies that they have products or they enjoy. So like companies like
Mhm.
Starbucks or Apple, Disney, Alimentation Couche-Tard because they love eating Doritos at the dipper. But I mean, who would buy a water ether company, right? I mean, and it's even worse because they are
Right.
dominating this market. They're just like the go-to guys for water heaters, boilers, tank, water treatment products. So everything under the sink or in your basement, literally. So not really exciting, but it works
Mhm.
and we need them. So that totally makes sense. They benefit from several growth vectors, ironically. So they are a dominant position in the US. So whenever there's like construction or upgrades for older properties, they're going to be the go-to guy. And they also developed the Chinese market. So when you're thinking about Chinese market, Indian market, you have the water treatment expansion. It is super important over there. A lot
Mhm.
harder to find drinkable water in those countries versus what we can find in North America. So they
Right.
can play on both sides. So they have the US with the construction and the upgrades, and then you have the Chinese and India market for water treatment. So and this company has been around for ages. It is a dividend aristocrat in the US. So if you follow the dividend aristocrat, it's not going to come up as a surprise. But I never see on social media, hey, I bought like 100 shares of AOS Smith because like it's so trending. So I thought it would be interesting to put those kind of like boring but reliable companies
Mhm.
on the table today.
But Mike, you've mentioned China and India, which brings growth, but it also brings volatility and uncertainty, especially with the current political environment. Is that something to worry about?
Is definitely something that hurts the stock price in 2025. That's for sure. I mean, we have the tariffs, we have margin pressure, we have competition in local markets as well. Similar way that I've been talking about Jameson Wellness. I mean, in China and in India, they're not just going to let an American company take over the entire market. They're going to say, you know what? We are also able to treat our water or to create or to sell water
Hmm.
boilers. So that is definitely a lot of competition coming after AO Smith. And when you're a leader, it's great because you benefit from pricing power, you have like more economies of scale, and you're well established. You have like a very solid playbook. But it also means that everyone is coming after you. So they're
Right.
not trying to fight their neighbors. They're just going to, I run almost like pooling everyone against you just to attack the leader, grab some market shares. And it's hard because you're being attacked on like right, left, and center. The water treatment is highly fragmented and highly competitive. So even if they continue to grow in this market, that doesn't mean that they will be able to do it with the same type of margin. So you may see revenue going up, but earnings struggling a little bit more if they want to keep their position on international markets.
So the next one is an oil and gas company, not your usual contenders, Mike. So what's the moat for TerraVest Industries that makes it worth your attention?
Well, yeah, it's not really an oil and gas company. I mean, it is in the energy sector, but they're not
Mm.
pumping up oil. They're not distributing natural gas. We've been talking about it a few times, but I think it deserves more of a spotlight. Ironically, they grow by acquisitions, and ironically, they made some acquisition nearby my town because they do own now Granby Composite, Granby Furnace, and heating products. So it's kind of ironic. And they're based
Wow,
in Coensville, which is not too far. So, anyways, you know they're there, but
of
it's
course.
their own now. It's been a while actually. So they are offering a wide variety of specialized equipment for niche market. We're talking about home heating products. We're talking about storage, compressed gas equipment. So anything that is around storing and using natural gas or home heating
Mhm.
products, but not the actual commodity. So they are not affected by the commodity price. If you're using home heating products that are based with natural gas, if it's cheaper, it's actually a good thing because you may even want to copy your neighbor and install a similar system into your house. So that could even be better for them. And they have been growing by acquisitions like there's no tomorrow over the past 5 years now. They are coming up on investors' radar. And this is one thing that I don't like about when you see a stock price going up super high super quickly is now all the investors are just looking for returns to determine if a company is a good one or a bad one. So they look at the year to date or the past 3 years, past 5 years, and they see hundreds of percents of returns. And they're just like, wow, let's jump on it. But they don't even look at the business model. They don't even look at why the stock is doing that well. So you always have to be a bit careful. And of course, now these days, it's a little bit tougher for TerraVest. I mean, they kind of set some expectations and now they have to deliver. And that could be a problem over the long run, but so far their metrics are doing well. And one thing that I really like about the fact that they make several acquisitions is now they are able to offer maintenance services through all their equipments and storage and vessels. And it's kind of great because when you have a natural gas tank, well, you want to make sure that it doesn't leak or it doesn't have any problems. So you're willing to pay to get those maintenance being done on a regular basis.
But Mike, TerraVest did not increase its dividend for years before 2022. So what makes you believe it will keep its dividend growth policy alive?
Yeah, that's a very good question and a fair point. And that's also the reason why it was not on my radar for several years. And when it started to grow, I was like, all right, it's been 1 year, 2 years. And I usually try to be very calm and patient with new dividend growers. So it has been paying a dividend for a while. But the thing is now, when you look at the revenue and the earnings per share, it grows very quickly. And of course, it's all driven by acquisition, but it's working because they're not just boosting their revenue, the earnings is following. And that's the important part here. After major dividend increases since 2022, the payout ratio is still under 25%. So they have plenty of room to do both with their capital. So on one side, they can continue to make acquisitions, but on the other, they're generating enough cash and under profit that they will continue to increase their dividend.
Right. Now, let's end with one I really never heard of before, and it's HCA Healthcare, ticker HCA. So describe that one to us, please.
Yeah, so this one I really have to thank Dave, one of our DSR members, because he is the one who found this one. And he was like, how come you don't even follow it, Mike? That doesn't make any sense. It has a perfect dividend triangle. And I'm like, all right, fair enough. I'm going to put a few hours aside. I'm going to dig in. It's the largest hospital operator in the US. They're present into 20 states, but mostly focused on high growth states like Texas and Florida. So growing quickly, 190 hospitals, over 2,400 ambulatory sites. Jesus Christ, that was a very tough one. And the company continued to expect to benefit from the demographic tailwind, of course, aging population in the US, having the insurance coverage as well. That's great. And they're making money at all the steps inside the hospitals because they're operating them. So you have the patient admissions, you have the surgical procedures. And the key here is to make sure that you are profitable at each step and making sure that you're getting paid, of course. So they're using a lot of data to process improvements. So they have this scale as well to understand how to operate in an efficient way to save money on fees and on costs, and then to make sure that they provide the right service and they can continue to grow the business. But they're doing an amazing job, and the dividend triangle is really, really solid.
Just before we continue, Mike, I would like to add something about the dividend triangle because maybe there are listeners out there that never heard of it before. So the dividend triangle is what we use at Dividend Stocks Rock as a first set of filters to find dividend growth stocks, interesting quality companies, which is the 5-year growth trend for revenue, EPS, and dividend. Is there anything that you would like to add about that, Mike, before we continue?
No, actually, it's a good point though, because for new listeners, I like to keep things simple, and I developed this quick filter. And what is great about it is when you find a company that is able to grow their sales on like a steady basis, do the same thing with earnings and share the wealth with shareholders, well then yes, of course you're going to spend more time into analysis of like a second layer of metrics such as like maybe cash flow or the debt or the payout ratio. But what I found over the past 22 years of investing is if you find companies that are growing sales, growing profit, growing dividends, chances are their payout ratios is in order. They have a good control over their balance sheet, and their cash flow metrics are also pointing towards the right direction. So it's kind of like
Mhm.
a shortcut to narrow down your list of stocks to only the ones that are having success and are thriving right now.
So I will put the link in the show notes. We did a dividend triangle article that if you'd like to have more info. So visit the dividendguideblog.com/257. Now going back to HCA, my hospitals come with high fixed costs. So I mean, there is a limit to the economies made when it comes to health, right? So
Yep.
is that the major downside for that company?
It is definitely capital intensive, so that puts constant pressure on margin. The other problem as well is the healthcare regulations could change, and then all the insurance in the US could, like, the rules could change at any time, and that could also affect the way they make money. You have to think about labor inflation because I mean nurses and doctors not that cheap as well.
Mhm.
So and sometimes when you have a big wave of patients, you will have to hire temporary staff or pay like overtime, which is also part of like the cost pressure that will hurt their margin. And finally, I
Mhm.
mean, as they grew successfully, the long term debt is also growing over the past 10 years. So, again, as I like to say, at one point you'll have to pay it off or pay a part of it. So, you
Mhm.
cannot just like
Mhm.
balloon this debt forever. But definitely the fact it's capital intensive is probably the major risk here because I mean, we need healthcare, we need hospitals, the population is aging. With immigration, we're going to have more people coming in. So all of those are great growth vectors. Then it's really a matter of being able to manage all your costs and maintaining a healthy margin.
Right. So, Mike, one last question before we go. How can investors differentiate from promising unknown stocks, sorry about that, from one that should remain hidden? Because, I mean, at one point, every stock, every hidden gem can make us feel like we're genius and smarter than the average guy, but it's not always the case, right?
Yeah, definitely. I mean, when you're at the bottom of the mine, maybe you're thinking that you have a gem in your hand and you just have a dark rock, which worth nothing. So definitely not get more excited because it's not a popular stock. It's always important to go back to knowing the business and you know the reason why we have been able to find some of those companies, and actually DSR members have been a very good help to find even more companies like Rollins, for example, that we didn't talk about today
Hmm.
because we covered in a previous episode. Those companies were found based on a metric approach. So by using the dividend triangle, so you start by studying numbers, and then the numbers are going to always tell a louder story than the current narrative. So being the underdog, being the stock that no one knows about, that's only good for those gimmicky ads, you know, just like, oh, find
Hmm.
the next Amazon that's gonna go 1000% profit in the next 6 months. I'm like, that's not the point. And I don't think because you invest in companies that do not benefit from this hype will actually do better or do worse. It's really more about using the rockstar list as I mentioned. So based on the dividend triangle, so the revenue, the earnings, and the dividend growth. And once you find companies with strong metrics, then you start learning about them. And you know, I'm super happy about my shares of Lemaitre Vascular, LMAT, that we
Hmm.
didn't talk about today, but we're going to talk about it in the next episodes next week. But
Right.
it's not always easy to have them in your portfolio because if they're flying under the radar, that means less investors know about them. And if less investors know about them, that also means you have less demand for the stock. So sometimes it's going to take more time for the stock price to grow because investors are not rushing their money into those companies to buy them. So it's
Hmm.
not always easy to become a patient investor and say, you know what? I found a business I believe in. I understand the business model. The metrics are great. And now I just a matter of like sitting tight and waiting until the rest of the world understand why this company is so great. So yes, it's great. You're going to feel smarter sometimes to find those. Doesn't mean that you're going to make better returns though.
All right, so listeners, there are two things you can download that are based on the dividend triangle, the Rockstar list that we've already mentioned, and Top Stocks for 2026, which is a free Top Stock booklet that we've made from a much bigger list for Dividend Stocks Rock members. I will put both links into our show notes at thedividendguyblog.com/257. You can grab them both. Like they're free, they're yours. Use them as you'd like, but the basic is that we use a dividend triangle for each of them. All right, thank you for putting the spotlight on these stocks that deserve more attention, Mike. Again, listeners, to get more ideas, visit thedividendguyblog.com/257. I will put the links to the Rockstar list and the top stocks. Next week, we share even more ideas with 6 low debt companies. Hit pause and the subscribe button underneath our podcast logo now so as not to miss it. And until then, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.